OK, then. We do have another caller on the line as well, Amanda from Sydney. Amanda, what's your question for the panel?
Hi, my husband and I are first home buyers and we're looking at optimising our borrowing power, and what we would like to do is do some research in the family pledge option that some banks offer. And my question is what the advantages and disadvantages to actually getting a family member to guarantee part of a home loan.
Yeah, well, because obviously, I mean, it's tough. It's the right time to get in, but often you don't have a good deposit.
Yeah.
Well,
Amanda, we're doing a lot of those at the moment, and it's from the family member's point of view, a lender's got to make sure that both parties really understand the transactions, because the way it works is the family pledge was built around benefits to the borrowers, which in this case would be yourselves. So the way it works is that lender A, or the lender, you buy property A, and the lender would lend you, say, in your scenario, say 100% of the value of the property. It doesn't need mortgage insurance, because then the difference between the 80% and the 20% required actually gets guaranteed in most instances by mum and dad's property. Mum and dad then, if they're, depending on mum's and dad's advice, sometimes mum and dad, this is outside the loan transaction, could potentially register a caveat over that particular property. But the way it works is that when that property ultimately increases in value and your loan comes down, once that equity component is built up and that hits that threshold of that 80% mark, the property is automatically released, which is mum and dad's property. But doing it this way, mum and dad are not the borrowers, and mum and dad's name does not go on title. So with that in mind, you get all the benefits of the first home buyer's grant, because the property is actually in your name, and they're just regarded as guarantors to save the mortgage insurance and get you into the property that you want to get into today.
Not to be a pessimist, but, I mean, is this a concern? I guess it's a worrying environment at the moment. People could lose their jobs. Unemployment's set to rise.
Yes.
Is this a concern for both?
They don't lend them... OK, the way it generally works is, say they're borrowing... Amanda, what sort of price range are you looking to borrow?
Is Amanda still there?
Is Amanda still there?
She is still there.
Yes, 400, 450.
400 to 450. OK, I'll give you a real example. Shall we use 425 as a benchmark? In your scenario there, when your loan drops either to $340,000, which is 80% of the 425, or your property increases, say, about $100,000, mum and dad's property is released automatically. The benefit to you here is that the mortgage insurance cost on that property at 425, it's in the vicinity of just under $10,000. So $10,000 added onto your loan today, at the highest point that it possibly could be, going over a period of point in time, that would probably triple in the real costs over the term of the 30-year loan. So by mum and dad's help today, one, you get into the property, two, it gives peace of mind to mum and dad that you're actually using the funds for a worthwhile purpose, hopefully, which is buying the home, and it gives the lender peace of mind too, knowing that if the parents are prepared to back you, well, the lender might also, if that makes sense. I'll just go over how they actually work. It is compulsory that mum and dad receive independent legal advice. Oh, right. So the way it works is that Amanda and a partner might go to solicitor A to do the transaction for the conveyance for them, and the solicitor or conveyance will go through the mortgage documents, what the responsibilities are, and then it's compulsory that Amanda's parents also go to a solicitor and seek independent legal advice and financial advice, so they actually understand that what John said is if anything was to go pear-shaped and that property was sold and there was a shortfall, then they could potentially be... Look, they would lose their home, hopefully, because we don't predict that property prices in that sort of category will probably come down much at all. But if there is a shortfall, then that's the only time that their property would come into play. So it's not that they're borrowing in excess of 100% to consolidate all their debts and buy the car, then combine it and then guarantee that. It's solely on the property as it stands today.